The cost of borrowing. Borrowing money can be beneficial for a number of reasons. However, it doesn't come without a cost. In this video, we're going to dig into the details around borrowing money to better illustrate the true costs. The cost of credit is the amount of interest that is paid on a loan, which is determined by more than just the interest rate. The cost is also affected by how long it takes you to pay back the loan. The longer it takes you to pay back, the more interest you will pay. The cost of borrowing money is impacted by where you borrow money from as well. If you have a good credit rating, you'll likely be able to get a loan from a major bank, where interest rates will be lower. If you have a poor credit rating, you may be turned down by a bank and have to resort to other sources, where interest rates will be higher. Be careful with companies that advertise services like payday loans and check cashing, often drawing attention to the fact that even people with bad credit are still approved. The fees, interest rate, and overall costs with these companies is often much higher than at a bank. When you go into a bank to apply for a loan, there will be an application process that includes the bank running a credit check to see your credit rating. Depending on your credit rating and credit history, your history of borrowing money and repaying those loans, the bank will decide if they're willing to loan you money, as well as the interest rate they will offer you. Always compare banks and interest rates before choosing a loan provider. There's no need to borrow money from your own bank, though often your bank will try their best to match a competitor's offer, but they may not always be able to. When borrowing money, especially for a larger purchase, another important component to consider is the down payment. This is the amount of money you already have to put towards the purchase. If you're going to buy a car for $10,000 and you already have $3,000, then you'll only need to borrow or finance $7,000. The more you can save as a down payment, the less you have to borrow and the less interest you'll have to pay. If borrowing money or financing a purchase, the total cost becomes the purchase price plus whatever interest rate you paid on any loan needed. So you'd actually have to pay more than $10,000 for that $10,000 car, since you'd have to pay interest on the $7,000 you borrowed. That's the price we pay for borrowing money. Here are a few more tips when it comes to borrowing money. Pay off credit cards each month. Don't carry debt on credit cards because the interest rate is usually very high. If you're stuck and can't pay the balance down, always ensure you at least make the minimum payment, as this can affect your credit rating and ability to borrow money in the future. Always comparison shop for interest rates when looking to borrow money. Paying back loans in the shortest amount of time will reduce your interest costs. Saving up a higher down payment will reduce the amount you need to borrow and result in having to pay less in interest. When looking to borrow money, consider asking these questions before making a decision. What is the interest rate? Is a lower rate available if you meet certain criteria? What are the payment dates and what are the penalties for late payments? Can the loan be paid off at any time if desired? If so, are there any fees or penalties? Are there any fees other than interest? What happens if I miss a payment or can't make a payment? Borrowing money is a big responsibility. However, can be very helpful in some situations as well. For some purchases like a home, borrowing money is almost always needed. Always ask questions until you are comfortable and confident you have all the information you need, and don't sign anything you're unsure about. By using credit wisely, you can minimize the costs that come along with it.